Okay, the balance sheet. Now, before we begin, let me give you a preview of what the balance sheet looks like. And this is the balance sheet that we're going to work with. I know that if you're looking, at the balance sheet for the first time, it might look all, challenging and complicated, but don't worry. We're going to break it all down and talk about every single line that you see here. But now, first, let's ask the question, why? Why do we even, bother with the balance sheet? What is the balance sheet trying to tell us, right? So before you invest in a company, wouldn't you like to know what the company owns and, how did they get those things, right? So the balance sheet actually tells us all of that with three different sections: assets, liabilities, and equity, right? So, and as you can see, this is the whole thing is the assets, and here is the liabilities, and this is the equity section of the balance sheet. So understanding these terminologies would be very important. So let's talk about them. Let me get rid of these balance sheets and we will come back to this later. So assets, liabilities, and equity. Now, what are assets? Assets, well, you can say broadly speaking, assets are whatever you own, right? So for a company, their equipment, their machinery, their factory, and we know that assets can be financial assets and physical assets. So cash is also a different type of financial asset, actually, you can say that. So cash in the bank, their factory, their machinery, and there are many more, but I'm trying to keep it simple. So assets are probably, broadly speaking, like I said, is whatever the company owns, right? Now, when it comes to liabilities and equity, these two actually tell us the story of how these assets were acquired, right? So if assets are whatever we own or the company owns, liabilities are whatever we owe, right? So we can think of a loan, let's say, right? Loan is a liability. So we can say any sort of obligation that we're going to have to a third party, that's a liability, right? So if you've bought something on credit, that'll be a liability too, right? So let me write this down. So buying on credit, right? So that's another type of liability. And companies do this a lot. They don't pay upfront for many of the things that they need, so they just go to a supplier and they have a deal with the supplier. They get the items that they need and they will pay that supplier back at a later date, but still they got to pay up, right? So that's an obligation, that's a liability, right? And when it comes to equity, you can say that's your net worth, right? By that I mean after, you can call it after debt, right? After all the debt has been paid off, whatever is left, that's your equity, that's your net worth. Now, I said that these two tell a story of how we acquire those assets. And because of that, there is a famous accounting equation. And the equation is that assets must always equal the sum of the liabilities and equity. So assets, whatever you own, is a combination, must equal a combination of the liabilities and equity, meaning that whatever you own, right, it either, the equity, if I say, I think this would make it easier, you can think of equity, whatever that comes out of your own pockets, right? So whatever we own as a company or on an individual basis, whatever you own or a company owns, the money that was used to acquire those assets either came from a liability, a loan or something, right? Or it came out of our own pocket, right? That's the only two possible scenarios, right? That's why we say assets must always equal liabilities plus equity. And I'm going to give, a few examples so we can understand how do these equations work out when we are placing them inside a balance sheet. So let's say you have I don't know, let's say $1 million, right? So you have $1 million in cash, right? Let's say the cash could be in the bank or whatever, doesn't matter. So you have $1 million and you have no debt, no nothing. It's just all yours, right? So in that scenario, what does your balance sheet look like, right? So let me give you the most basic form of the balance sheet, and we saw it in the previous screen that we have these A stands for assets on one side, and we have L stands for liabilities, and E stands for equity on the other side, right? So if you have $1 million, right, we know that cash is a form of assets, right? So you have on this side cash, and in terms of dollar amount, that is $1 million, right? And since the whole million is yours, so you have no debt, no nothing, so your liability is 0, right? And in that scenario, if somebody asks you, what is your net worth? How much are you worth, right? You would say, my equity, my net worth is 1 million, right? So you add these two, that's 1 million, your total asset, 1 million, right? You see the balance? That's why it is called the balance sheet, right? Because, it always has to balance. Okay, so that was simple enough. Now let's say, and let me use a different color maybe. Let's say you don't have $1 million, right? Let's say, forget about this. Let's say you have, I don't know, let's say 500,000, right? So you have $500,000. Now, there is a house that you want to buy, and the house costs, let's say, $1 million, right? No, probably not this house, maybe the house behind it, but maybe this is a special house. So let's say that the house that you want to buy costs 1 million. Keep in mind, you have only 500,000, right? So to buy this house, the other 500 has to come from somewhere, right? Maybe you go get a loan. So in that scenario, what does your balance sheet look like? So let's have another balance sheet. Again, we have A for assets, L liability, E for equity. So you have 500,000, that's your net worth, that's what you have, right? And you want to buy this house. So you go get a loan of 500,000, that's your liability. So in this section, we write 500,000, which is the loan, right? So you add these two, you can go buy the house. Now you have an asset, which is the house. And the house, in terms of dollar amount, it is worth 1 million, right? Again, we add these two, we have 1 million here. The total of your assets, 1 million, right? Again, we have that balance that we were talking about, right? A equals L plus E. Now, yes, although you have an asset, which is the house, and that house is worth $1 million, but the whole million is not yours. So if somebody asks you, what is your net worth, you cannot say, I'm a millionaire, right? I have $1 million house, so my net worth is $1 million. No, 500,000 of it is yours. The rest, belongs to the bank, right? Until you pay off that loan, then slowly, by whatever amount that you're paying off that loan, it will be added to your equity, right? Until you pay up the whole amount, then your equity will be the same as your asset amount, right? And so that's one of the ways that we can, increase our equity. One way is to pay off the whatever liabilities that we have, right? So if I pay off after whatever number of years, let me again use a different color. So after whatever number of years, I pay off, let's say, 100,000 of these, right? So then my liability becomes 400, right? And this will be added to this side. So again, here I'll have 600 of equity, right? My equity went up because my liability went down, right? But still, you add them up, that's a million, because under any situation, any kind of scenario, there has to be a balance. Now, there is another way that your equity can go up, and that's the scenario that the price of the house that you bought appreciates, right? So if after a few years, let's say, the house becomes more expensive, so the price of the house appreciates, right? Now, if that happens, that has nothing to do with your loan. Your loan is whatever you owe to the bank at the beginning. That's it. And that's fixed, and then you start to pay that off, right? If your house suddenly starts appreciating, that's all yours, right? So let's say after a few years, keeping these constant, let's say after a few years, your house now is worth, let's say 1.5, right? So that 500,000 belongs to this side, to the equity side. So now your equity is not 600. It is, and assuming that we have paid off that 100. So I'm going to keep this side constant. So that 500,000 will become here, right? So you have your equity, I'll write it here, 1.1, right? Again, we add these two up, 1.1 and 400, 1.5, and the asset, 1.5. Excuse me if it became a bit messy, but we're going to see these things many times over and over, so you're going to get the whole idea. Here I'm just, trying to make the point. So as you can see, the only thing that I want you to take away here, forget about the house appreciation and all those kind of things, although if you got it, perfect. If not, we will see it again. But the point that I'm trying to make is that balance has to happen at the end, right? That's why we have the balance sheet. So the point that I want you to take away here is that any asset that you have or a company has must equal the liabilities plus the equity, right? And I say you or a company because we can have a balance sheet on an individual level as well. Let's say when you want to go to a bank, right? You want to go get a loan. The bank in that scenario looks at your balance sheet, right? So they take a look at what are your assets, and if you have any loans or bad debt from before, bad credit or whatever, right? And based on those things, they will decide whether to give you a loan or not, right? So when we are going to take a look at the companies, in the future that we will do a sample, is that we are also going to do the same. We are going to take a look at the assets of the company, the liabilities that they have, how they got those assets, whether it's possible for them to pay off those things or not, all those kind of things. So and we will see all of that pretty soon. So I hope that was clear enough. Now from the company's perspective, for them to acquire those assets that they need to grow and expand, to make new products, to buy that beautiful building or whatever, right? Still that equation must hold when it comes to the balance sheet. So the total assets of the company must equal the total liabilities plus total shareholders equity. Here we say shareholders equity because when a bunch of people chip in, that's called the shareholder equity, right? So in other words, it has to come from the shareholders pocket, their own pocket, or it comes from a third party, right? Now companies obtain funds from investors, basically from the sale of debt securities, meaning that they issue bonds, and I'm not going to talk about debt securities here all that much because, we have a section dedicated to it. But bonds are also like, loans. So they can obtain the funds from the sale of debt securities, or they can go to a bank and get a loan, right? Like a normal loan. Or they can do it through the sale of equity securities. This here means selling shares, right? And selling shares basically means you're bringing in new owners. So you're getting the money through this side, right? And equity securities have many different types. And again, we have a section dedicated to it. We will talk about, but the most common type, which is called common share, that's the type that you actually bring in new owners. So these two here, the bond, the debt security and the loan, is called raising money through debt, right? And this calls raising money through equity, right? So the balance sheet, also called statement of financial position, right? And that means the balance sheet provides information about a company's financial position at a specific point in time. This is important, right? And normally when you look up a company's balance sheet, it is very common that you see that balance sheet, let's say it's as of 31st December 2000 whatever, right? So you see that quite common, and that means that we are looking at the assets and everything as of this date. So the balance sheet shows what the company owns, the assets, and how it is financed, right? The financing includes what it owes others, meaning the liabilities, and shareholders' investments, and that's the equity, right? And we are looking at all those things as of a certain point in time. And that's normally the point in time, right? So let's get back to the balance sheet that I was showing you before. And let me make, and we are going to take a look at this side of the balance sheet in the next video. But before we do that, let me just make a few points. And first of all, that's what I meant. So that's common that you see as of 31st 2022, as of 31st December 2021. And it is quite common that you see at least 2 years worth of data. So you can compare, right? So what were the assets in 2022, what were the assets in 2021, right? And if you can have the more years the better, but 2 years is the minimum convention, right? So we are taking a look at the assets and liabilities and owner's equity as of 31st December 2022 and 2021. Now, that's the point that I would like to direct your attention to, and that's 2022. We come down, total assets 496. 2022, total liability and equity 496, right? 2021, 565. 2021, 565. Again, we see that balance. A equals L plus E, right? And if you do not see that balance in there, well, there might be a mistake, or I don't know, somebody's lying about something, because that balance has to be in there, right? So another point that I would like to make before we leave this screen is that, assets and liabilities are normally, categorized into current and non-current. Same goes with the liability, current and non-current. And what do we mean by current and non-current? I'll explain that soon. So in the next video, we are going to talk about this side of the balance sheet, which is assets. So see you in the next video.